This is the Bloomberg Surveillance Podcast. I'm Lisa Abramowicz, along with Tom Keene and Jon Ferro. Join us each day for insight from the best in economics, geopolitics, finance, and investment. Subscribe to Bloomberg Surveillance on demand on Apple, Spotify, and anywhere you get your podcasts, and always on Bloomberg.com, the Bloomberg Terminal, and the Bloomberg Business app.
Bob Dole's with us now. Wants to talk about markets, CIO of Crossmark Global Investments. Bob, good morning to you.
Same.
Let's talk about retail sales, 25 minutes away. Are we going to see that resilience in this US economy, this US consumer, in the data we're set to see in this hour?
You just put a lot of good things, the two of you, on the table. A soft landing is like putting a thread into the needle, and the eye of that needle is shrinking. It's getting tougher and tougher. The consumer eventually will come to their knees. We always see it at the low end. We see it with credit extension. We see it. Wage growth is strong. How long will it stay strong? And that has just fueled the consumer, and it's fueled our economy. And this thing is kept on going, despite all the things in the background that you just put on the table, including the lagged effects of the Fed going from 0 to 5.25. We have not felt all of that yet.
Let's unpack that. It will happen eventually. Are we seeing signs of it now? You mentioned credit. You can see it through credit, maybe one way. Another way might be to see it in the official data. We'll see that at the bottom of the hour, 8:30. Another way might be the earnings. Across those three things right now, credit, data, earnings, are you seeing a slowdown?
Not really. It's all lead indicators. The coincident indicators are positive. Some of them are getting a little mixed. It's going to take some more time to go there. We've been, since the first of the year, saying recession starts sometimes between Labor Day and the end of the year. Still sticking with that. Think it's a mild recession, as many do, although recessions left most people's vocabulary, as you know.
But where does that recession come from if you do see the strength in consumers? And a lot of people have pointed to the student loan issue. And I was reading this article, this survey by Credit Karma, and it was showing that 45% of student loan borrowers say that they are not going to repay. They're basically going to be delinquent for 12 months because they're not going to get penalized for being delinquent for 12 months. So aren't we basically getting a stealth stimulus ongoing that will remain in place for a while?
Well, it's been the story, and it's lasted a little longer than many people thought, and it's still not finished. But eventually consumers will come to the realization that things are a lot more expensive. Inflation's still a problem. They have no savings at the lower end of the consumer bracket, and that's a problem. And they're going to have to retrench some or find a second job, and they've already done that.
What's the hedge? What's the defensive play at a time when a lot of the strongest companies have incredibly high multiples and you're looking at bond yields that are not giving a consistent message?
Yeah, I think that within the equity market, you try to focus on companies that have high earnings predictability, high earnings persistence, and are not selling at crazy prices. And that's not a whole lot of places. I like the HMOs, for example. I've not given up on tech, but I want to be careful what PE I'm paying for my tech. So some of the semiconductor stocks, some of the software stocks, they're not so cheap. Visa and MasterCard, two names I still like. They've gotten more expensive. So you have to pick your spots, and I come back to earnings persistence and cash flow generation.
Let's talk about the retailers then. Home Depot out this morning, Walmart later this week, Thursday, Target tomorrow. Have they still got that pricing power? Can they keep margins pretty steady, or do those margins get eaten away at?
Eventually, and I think we'll see some of that like now, those margins get eaten away. Because you see, companies can only raise prices so far, and you're already seeing consumers begin to make noise and balk and stop buying some things. It won't be everything, but slowly but surely you take the edge off. We have to operate on 8 cylinders to keep the thing where it is now. And even if we back off to 6, that's going to disappoint a lot of people with stock selling where they are. They're
well, let's highlight the
expensive.
winners. Forget tech, cruise lines, airlines. Are we at that point where we've reached consumer price intolerance? They just don't want to pay it anymore.
Well, as you said a minute ago, people are flying around. We go on an airplane and, every seat's taken. So we're not there yet, but we'll get there.
Okay, so what's going to get us there? Because everyone's been saying this, that the consumer eventually will push back, and then they haven't. And then you go out to eat, and it costs twice what it used to. I mean, honestly, this is the kind of increases that you're seeing.
Yeah, so it was subtle. We had 15 months in a row of better than expected monthly employment numbers. The last 2 months have been below expectations. So there are cracks beginning to develop. I don't want to come across as the economy's tanking and over, want to be a bear overall. I'm just cautious. And I add to it, I said already, I'll say it again. If the PE were 14, different story. But, at the peak a couple of weeks ago, I looked at my screen on trailing earnings, 23 times earnings.
When you talk about being cautious, what's the ballast? If you talked about your equities, is it cash? Is it going into duration?
I think having some cash in your portfolio when it yields 5% is not a stupid idea.
Have you been increasing it?
In the balanced accounts where we can, in the equity market neutral portfolios, we've been bringing our exposure down and therefore our cash exposure up, yes. Bonds, own some bonds. I'm not sure that we've seen the high-end yields yet, but I'd rather begin to nibble at 4.25 than 3.5, where we were not that long ago.
Well, you think start to go out along the curve, start locking some of this stuff in?
Slowly but surely, yes.
Heard the same thing from Lisa Shallett over at Morgan Stanley. You think we face that reinvestment risk, rate cuts on the horizon?
That will happen at some point, so I don't want all my eggs in the short-term 5% basket. Look, a year ago, 18 months ago, 1.5% 10-year Treasury. That was a bad deal. 4.25, I think I'll think about it.
It's unthinkable, isn't it? It wasn't that long ago.
No.
It wasn't that long ago.
And it happened fast.
I know, it really did, Bob. It's happening fast now. Bob, it's good to see you. Thank you,
All the
sir.
best.
Thank you. Bob Dole of Crossmark Global Investments. Jordan Rochester joins us now, G10 FX Strategist over at Nomura. Jordan, great to catch up with you, buddy. Let's just start in the UK at the Bank of England. Record wage growth. Are we bringing them back in for more rate hikes to come?
John, I think that wage number will definitely make the Bank of England absolutely think about raising rates at the next meeting. We think there'll be 2 more rate hikes this year. So we already thought there was enough data to tell them you should probably keep hiking more. I do think the risks are that we get a weaker services CPI, perhaps not this month, maybe next month, and that the risks are actually tilted to just 1 hike rather than 2. The idea of having 2, maybe 3, would require a re-acceleration in that services CPI. So I always, John, think that the labour market's the most lagged indicator to track as a central banker. Rewind back 2 years ago, the ECB, the Bank of England, all these other central banks that were pointing out weak wages as a reason not to raise rates was actually a ridiculous thing to look at, because you missed all of the energy and commodities inflation that was coming, and it's why we are where we are today, with central banks having to make up for lost time with all these rate hikes quite late on in that cycle, John. So strong wages, fantastic for those workers. Pretty difficult for the Bank of England to turn dovish with those numbers.
Sterling positive or sterling negative if they have to hike more?
Well, look at the reaction today. Euro sterling is the way to look at it. Sterling tried to rally, and then it came back off, and euro sterling is pretty much flat on the day. If the Bank of England raised rates at 25 basis points like we expect, it wouldn't really move the needle for sterling. I think what will be really interesting is if we get some more negative news on growth. We're starting to see that in China, for example, but we're also having pretty dismal surveys out of the UK as well when it comes to price pressures. They're all turning lower. Maybe at the next meeting we'll get a better sense of whether we will get that extra 50, so 2 25s in a row.
How much is that weakness that we're seeing in China bleeding through not only to the UK, but Europe and the euro?
I think what you were saying earlier, Lisa, is spot on. There has been a little bit of decoupling. You look at the likes of risk on in the US market, the move in US yields. Yet, if you were to use the usual frameworks, when China slows down like this, usually it's risk off and very dovish, and it leads to dollar strength. And this is kind of what we're seeing in dollar CNH, so that's a clear trade. We think dollar CNH gets to 750 perhaps. That's the sort of move we're looking for. We're doing it in a basket format. But it's not leading to massive euro-dollar weakness, which is very odd. And it's similar for sterling as well. It used to be if CNH moved like this, you would absolutely have to be short euro. And the reason for that is because of this decoupling. Equities are rallying in the US more broadly over the past few months, and that's held up euro.
Can it last? And I noticed that you actually abandoned your strong euro call recently, and you said, you know what, I actually see it being a bit weaker from here. What triggers that, if not the bad data out of China and this concern around the inability to stimulate?
The hardest part about FX, Lisa, is there's 3 pillars to consider. 1 is what's going on with equities, 2, what's going on with rates, and 3, what's going on with commodities. And for quite some time, I was leaning on that equity pillar. The sort of rally we'd had in equities over the past few months was one of the reasons we had that euro-dollar call. we're looking for topside. We still are by year end, but in the short term, I see the other two pillars really dominating, which is the rates market says euro-dollar should be towards 105. That's not a good thing where we are at current levels. And of course, with commodities, we've had a march higher in oil prices. And natural gas, one of the biggest imports for the euro area energy supply crisis, has perked up recently of late. So it's made me more nervous watching dollar CNH move the way it is, default risks building up in China, low credit demand. We saw new WAN loans collapse. That in the short term, given we've got very little data now until we get the next CPI and NFP reports, and we've got Jackson Hole, but I think in the short term they're not catalyst enough to boost euro. I'm surprised euro wasn't on an 111 handle after that CPI report. So a few disappointments with the reactions in the market, and going forward over the next 2 weeks, only Jackson Hole to really talk about. That's not a reason to be long euro-dollar, but we are long euro versus Norway, and we are long euro versus sterling. So there are still euro upside bias in our view.
Jordan, what you just described smells like Eurozone stagflation. Is that what it is?
Well, inflation's going to come down, John. It's going to come down quite quickly according to the sort of PPI and surveys. So the stagflation concerns, I think, were more last year's story. But the growth numbers, ZEWs this morning, were pretty disappointing. I thought maybe we start to see positive momentum in European data surprises. They were so weak that maybe they improved, but ultimately the surveys suggest that it's going to be a pretty weak outlook for European growth. And my problem on that side is I'm not sure where the next stimulus is going to come from. The Fed's not cutting rates until March next year. The ECB is not going to be talking about cutting rates until later next year, October, November time. China's not doing a big fiscal stimulus so far. So it is a combination that makes it really hard for me to see why surveys and growth surveys should really pick up. So yes, in answer to your question, it's still a bit like stagflation, but hopefully that inflation component comes down.
So Jordan, just quickly, you think Lagarde is done?
We do. We do think the ECB is done because we think that the data over the next few months will develop in such a way that will justify no more rate hikes. I think the ECB and the Fed have both introduced the skip concept, and hopefully by the time we get a few more data reports, that will then say we don't maybe need to hike at all. The Bank of England is in a weird place where they don't give that sort of strong forward guidance about skipping or not. Hopefully we start to see that build up as a narrative for the UK as well in the next few months too.
I've got a birthday present for you. We're not going to talk about Aston Villa, okay? Just going to let you go.
Aww.
We won't talk about the score over the weekend. Jordan, happy birthday.
So
Thanks,
sweet.
John. Cheers, guys.
I'm
Jordan
tearing up.
Rochester and Nomura. Jordan, thank you.
Lindsey Piegza, someone who's been calling for rates to be much higher, potentially even with a 6 handle for the Federal Reserve to get inflation under control, joins us right now. She is a chief economist at Stifel. Lindsey, what's your view on why we saw such a big upside surprise on retail sales?
Well, this certainly was a stronger than expected report, and no doubt this will boost optimism that because of the resilience of the consumer, we can achieve that soft landing. But I would push back a little bit in the sense that we don't need to put too much focus on 1 month's numbers. What we have seen is a tremendous amount of volatility in terms of consumer activity month to month, suggesting that, yes, while this was a welcome step in the right direction, consumers are increasingly shifting the goods and services in their basket on a month-to-month basis, something that they do, something we do as consumers when we are increasingly concerned about our financial footing. So while this is, again, beating the expectations for the market, I wouldn't necessarily say that this is a trend that can continue to rise, particularly against the backdrop of some of these factors that prove artificial support, drawing down savings, a last sputtering of state and local stimulus. We see hardship withdrawals from 401ks up over 40% on a year-over-year basis. But while this will provide a temporary support, this is not an indefinite support to the consumer.
So where does this fit in, Lindsey, to your view that you previously had, that the Fed had a lot more work to do, that they had to get to a level that nobody was gaming out, or very few, of 6% or north of that?
Well, I think this is going to make the Fed's job more difficult because the longer it takes for the labor market, for the consumer to show that needed weakness or respond to earlier policy tightening, the more aggressive the response from the Fed must be, thus ensuring an eventual downturn. So the notion that the fact that consumer has continued to be resilient across the first 525 basis points, supporting the notion of a soft landing, no, I would argue it's quite the opposite. That simply means the Fed will have to be more aggressive, raising rates higher and keeping rates higher for longer than investors had anticipated, suggesting that the downturn potentially and eventually will come and may be more aggressive, more of a downturn than previously anticipated if the Fed didn't need to raise rates quite as much to squash out inflation.
Lindsey, you said two things: raise rates higher and keep them there for longer. And those were the ideas that people had. But some people are starting to think, okay, what if the Fed is done with how high they're going to raise rates, but they are going to keep them there for longer? And that's what we're seeing priced into the market gradually with some of the highest longer term expectations for Fed funds rates that we've seen in this cycle. At what point does that cause more damage in your view?
Well, I think it's certainly going to cause more damage. Again, the more pressure on the Fed to respond. Now, if we continue to see this type of resilience, if we continue to see third quarter GDP surpass earlier expectations or surpass what we saw in the second quarter, I think the Fed doesn't necessarily need to continue to raise rates indefinitely. But once they reach that sufficiently restrictive level, as you mentioned, we've long conceded that will be 6% or above, the Fed is likely going to be forced to keep us at that elevated level for some time. The Fed itself has said rate cuts are not in their base case scenario for 2023, but even 2024 remains a sizable question mark if we aren't able to see that intended result. Remember, the Fed is raising rates to tap down consumption, tap down investment, and result in a slower level of activity in order to get that more benign inflation. But thus far, the economy is pushing very hard against the intentions of tighter monetary policy.
If you are just joining us, we are just seeing the ramifications of retail sales numbers that came in significantly higher than expected. We're seeing the overall month-over-month headline number of 0.7% versus expectations of 0.4%. The control group, which does factor into the U.S. gross domestic product figure, came in at 1% from the expected 0.5%. We are seeing two-year yields surge past 5%, 10-year yields and 30-year yields both reaching the highest level since October, climbing up. We're seeing 30-year yields 4.32%. Lindsey Piegza of Stifel with us. And Lindsey, I really want to get your sense of what could potentially halt this spending. You were saying it can't persist. You're not going to see this forever. Some people have pointed to the student loan repayments that are going to restart in October. Do you give credence to this sort of idea that we could see some sort of tightening and fiscal tightening on that front going forward?
Oh, absolutely. There's a number of factors. And remember, even with this monthly increase, beating expectations, when we take a step back and look at the longer term momentum, it's very clear that consumers are beginning to slow their activity. Coming out of the gate from the great the shutdown, we had a double-digit growth. Then we slowed to 8, 6. Now we're talking about bouncing around 2% on an annual basis. So while still positive, the consumer has clearly pulled back. And these other factors, as you mentioned, monthly payments for student loans, additional housing payments coming back online. This is going to compound the pressure on the consumer. Now, there are some temporary supports that we're still tapping into. There still is a sputtering of state and local stimulus. Consumers are turning to 401ks. Consumers are ramping up credit card debt. And with the relative health of the balance sheet, meaning we paid down debt during the closure, during the pandemic, there still is some wiggle room for the consumer to expand that balance sheet. So I'm certainly not suggesting that the consumer is going to immediately fall off a cliff. But what we are seeing is these indefinite supports beginning to wane, putting additional pressure on the consumer eventually as we head further into the second half of the year.
What do you expect Jay Powell to say in Jackson Hole next week, given all of this?
Well, I think one of the biggest questions that investors have is for how long? And that's really what I think Chair Powell is going to focus on. It's not necessarily how high, because it seems as if the committee is of one mind that we're nearing that terminal level. Whether it's 1, 2, maybe even 3 additional rate hikes, we're up near that sufficiently restrictive level. But how long will the Fed need to keep rates, at that elevated level? I also think he's going to talk about the context of inflation against monetary policy. How does the Fed respond if we see a reversal in inflationary pressures? Is that even a scenario that the Fed is considering? And how does the committee balance the risk between raising rates even higher than previously expected, slowing the economy, against the risk of wanting to obtain that 2% inflation target? So there's a lot of questions that investors are going to be listening for, that I'm going to be listening for, in terms of how to gauge the Fed's mindset on these broader themes for inflation and monetary policy.
Lindsey Piegza of Stifel.
Joining us now on Washington and the latest developments down in Georgia, Terry Haines, founder of Pangaea Policy. Terry, wonderful to catch up with you, sir. Always thoughtful, our conversations together. We mentioned this in the last couple of hours, and I think it's the appropriate place to start. We've got cases now in New York, in Washington, D.C., in Florida, in Georgia. Terry, how do you rank those, just in terms of importance?
Oh, importance? I think it's far too early to tell for one reason that you and Lisa were just talking about, which is the timing of the cases. There's a lot of different ways you can slice these things: federal versus state, racketeering versus conspirators, all kinds of things. I'd rank them in order of how they're actually going to come to trial, and to some extent, it matters greatly, frankly, I think, whether they're televised or not, as you say. I mean, the closer people see what's actually going on and why, they're going to have more of an opportunity to make up their minds on it.
Terry, can you elaborate a little bit? Why is the televisation of this important? You said to make up their minds, but what do you think the outcome will be of having it very much in the public eye?
I think there's just an immediacy to television, frankly. And, I think we've seen that over the past 60, 70 years, just in terms of how people perceive candidates and people choose candidates. So, very broadly, there's that. But secondly, there is a debate, more than a debate in the country, about whether this is politicized prosecution or whether there's something here. So there's going to be an awful lot of pressure on the Fulton County DA to show that these charges are real and they're not the kind of standard splash that prosecutors do. Prosecutors tend to go in front of grand juries, particularly. You go big, you go broad, you get the maximum you can from the grand jury. In this case, it's going to be, did she overstep? Does she actually have evidence? And of course, the other side has a great deal to say about how to interpret the evidence. So this is going to be on a pretty big stage, and even more so if it's the first one.
Terry, there's a real question around the different poles of the political sphere right now and how people are going to respond to court cases that most of America, or many of Americans, have already decided about, regardless of what's happened yet. What do you think the outcome will be to some sort of conclusion of the trial if there is some sort of conviction? I mean, I'm just trying to play out the political risks here on a social level.
Well, I think firstly, and I've said this to you all before, I think there is greater uncertainty around the 2024 presidential election because you have increased risk for an uncertainty about Trump and about Biden. On Trump specifically, I think what you've got is a situation where, if there's a conviction, my instinct is what happens is that it accelerates this death by 1,000 paper cuts process where people say, you know what, regardless of Trump policies, regardless of whatever, movement, kind of anti-establishment movement I think exists here, I'd be better off with another candidate. So I tend to think the more the prosecutions start landing home, the more that the Republican electorate turns elsewhere.
Right now, Terry, as you game out that political risk and you talk to different clients, what are you telling them to prepare for? What is the way that it will manifest itself if we're not focused as much on, say, debt reduction or some of the tangibles, nuts and bolts of fiscal governance?
Well, I say a couple of things. One is that the first action in the presidential primary process is 5 months, I think, from today. I mean, Iowa, I think, is 5 months from today. So, that's a very long time in politics, and there are examples all over the board about how, somebody that was leading in the polls today, didn't win different primary challenges. So, number one, there's that. Number two, keep your eye on the panoply of things that are going on in Washington. Not just the Trump matter or the Biden matter. You've got, just in the next few months, you've got I think a shutdown likelihood, a government shutdown likelihood at 60%. You've got probably no meaningful action on debt and fiscal, which markets are increasingly interested in. You've got everything from the China economy to the Ukraine-Russia matter to think about, bank capital standards, and all the way down to John's favorite topic, UFOs. So, what we've got is a situation here where there's an awful lot of risk coming out of Washington on a variety of fronts all at once, and it behooves investors to pay attention to all of it, not just this particular bread and circus.
Terry, how did you know that? How did you know that? Terry, how real is this down in D.C. when you watch these hearings? How real is it?
Which part? The UFO
UFOs,
part?
Obviously, Terry.
The cheap and easy line is to say anybody that watches Washington with regularity, does believe in, that there's something out there that, is affecting things that isn't us. I think there's an awful lot of circumstantial evidence on the UFO matter, as there always has been. And, they're going to need to get to the next step to start convincing people.
Terry, thank you, sir. Terry Haines of Pangaea Policy down in Washington. Drew Redding joins us now, home builders analyst for Bloomberg Intelligence. Drew, can we start with Home Depot? What have you learned from the numbers this morning?
Yeah, so Home Depot had a modest beat. Same-store sales down 2%. Expectations were for a decline of about 4%. I mean, this was pretty much in line with what we were expecting. There's been some noise quarter to quarter with lumber and weather. The key takeaway is that they reaffirmed their full-year guidance, calling for a decline of 2 to 5%, which includes a backdrop of the broader home improvement market falling 5 to 10%. So they reaffirmed this back at their investor day a couple of months ago, so not a whole lot of new news from this release. They did confirm that there's still caution among consumers and that big ticket discretionary projects are still under a little bit of pressure.
Forget big tech. One of the stories of the year in the equity market has been this rip-roaring rally in the home builders. Drew, Lisa and I were just talking about how frozen this housing market is in America. Drew, can you put some numbers on that? Just how frozen are things at the moment?
Yeah, so if you look at the existing home market, sales are down more than 30% from their peak. I looked at the 30-year mortgage rate before I came on this morning, and we're at 7.25%. So, I mean, that's kind of startling. And just to give you some perspective of how out of whack rates and prices seem, home prices would have to fall somewhere around 35% in order for monthly payments relative to incomes to fall back to trend levels. Now, we don't think that's going to happen. The main reason is because the market is frozen. There's no inventory in the existing home market, and that's really what's put the builders in a unique situation. They've been able to bring new product to market. They've been able to help customers make their monthly payments work by offering rate buy downs. So they've kind of been in the sweet spot with higher rates, which is something we and others didn't really expect coming into this year.
Bear with me, Drew, but immediately I start thinking, does this mean that when the Fed cuts rates, or if they cut rates, maybe they're going to hold rates here for a very long time, most people expect them rates to go down, that home builders will sell off, that will actually reduce some of the proposition that they offer at a time where you start to see a little bit more loosening in the housing market?
So it's an interesting question, and the reason I said that they're uniquely positioned is because we think they could benefit in the current environment where rates are around 7 and they're buying them down to 5.5. But if rates fall back to 5.5% naturally, you've expanded the buyer pool, so it increases mobility. So we think even in that environment, builders can still do well. I think the biggest risk, and it's not something we're seeing now, is that you get more stress in the labor market and unemployment starts to spike. That's where you would start to see pressures on home prices and more supply coming to market because there's forced selling activity. That's just something we haven't had to this point.
Home builders have also been in a sweet spot because you've seen lumber prices come in. And from Home Depot's earnings, that's been actually a headwind for them. That's been a problem. They've actually seen margins come in with some of their supplies and their sales increase not able to be passed along as much. How much is that kind of one of the variables that can back up a home builder or not if you start to see lumber prices go back up?
Yeah, so right now, profitability for the builders in terms of gross margin has benefited from the fall in lumber prices. We expect that to continue over the near term, but they have started to tick back higher, and that could add some pressure to margins alongside the increased use of sales incentives. So it's certainly something to watch because obviously, as you would expect, lumber is the biggest component of a house.
When, Drew, do you expect mortgage rates, as you mentioned, 7.25%, 7.5%, if you look at bank rate, when will that actually trickle out into valuations in a more material way? Are we just basically saying that because of the term structure, it's not going to have the ramifications that anyone expected it to have?
Yeah, it's certainly an interesting dynamic that's taken shape. And I think the reason that higher rates aren't having an impact on home prices and the valuation of houses is because there's no supply. In order for price to see a dramatic decline, you'd have to have that forced selling activity, which would be associated with an economic recession and rising unemployment. We've got very well-heeled borrowers out there. We haven't seen those exotic loans this cycle. So we have good borrowers. They're locked into low fixed rates. So there's really no reason for them to be forced to sell absent a broader economic recession.
Drew, can you give me that number again for those that missed it? What do housing prices need to fall by to go back to trend repayment levels?
So in the existing home market, home prices would have to fall about 35% in order for that monthly payment relative to income to kind of fall back to those trend levels we talked about.
35%. Drew, thank you. Drew Running there of Bloomberg Intelligence.
Subscribe to the Bloomberg Surveillance Podcast on Apple, Spotify, and anywhere else you get your podcasts. Listen live every weekday starting at 7 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can watch us live on Bloomberg Television and always on the Bloomberg Terminal. Thanks for listening. I'm Lisa Abramowicz, and this is Bloomberg.